Imagine finding out this software company, originally built to power the CIA's most secretive manhunts, is now, like, actively managing the inventory at your local grocery store.
Yeah, it is it's a profound structural pivot.
Right. You are looking at an organization that built its entire reputation in the shadows of the defense world. And almost overnight, they've become the digital backbone for everyday corporate America.
We're watching a highly specialized military contractor essentially turn itself into the central nervous system for the global commercial supply chain.
Exactly. So, welcome to your custom deep dive. Today is Tuesday, May 5, 2026, and we are unpacking a massive stack of financial filings that dropped yesterday.
Specifically, we're looking at Palantir Technologies Q1 2026 earnings report and their Form 10Q.
Right. And our mission today is to help you understand exactly how Palantir just completely shattered Wall Street expectations.
And really to explore how a company once known for, secretive government defense contracts is rapidly transforming into what its CEO calls an AI infrastructure titan.
Yeah, so let's unpack this, because earnings reports can usually be, well, incredibly dry.
Oh, definitely. They're normally just rows and columns of static numbers.
Right. But the narrative buried in these specific filings, it actually reads like a thriller because the numbers are just so aggressively large.
The top-line revenue growth is really the immediate shockwave here.
Yeah, let's get into that.
So looking at the Q1 2026 release, Palantir's total revenue hit $1.633 billion.
Wow.
Yeah, that is an 85% year-over-year growth rate.
Which is just massive.
It really is. I mean, for an enterprise software company operating at a billion-dollar quarterly run rate, accelerating to 85% growth is unprecedented. It's their highest ever year-over-year growth rate.
And it gets even more concentrated when you look geographically, right? Their U.S. revenue specifically grew 104% year over year, hitting $1.282 billion.
Yeah, the U.S. market is just exploding for them.
And based on that momentum, they actually raised their full year 2026 revenue guidance to somewhere between 7.65 here and $7.662 billion.
Which represents a projected 71% growth rate for the entire year.
Right. Which totally explains why their CEO, Alex Karp, is out there comparing Palantir's momentum to the absolute titans of hardware.
Yeah, he specifically name-checked NVIDIA, Micron, and SK Hynix in his shareholder letter.
But hold on, let me push back on this whole titan narrative for a second.
Okay, sure.
Because, we have seen this movie before in Silicon Valley. Software companies extending into AI often grow incredibly fast by simply buying market share.
Right, the classic growth at all costs model.
Exactly. They burn a mountain of cash, they offer heavy discounts, and basically sacrifice the bottom line just to get that top-line growth.
Yeah.
So are they actually making money, or is this just growth at all costs?
Well, historically, the tech sector forces you to choose, right? You either have explosive growth or you have deep profitability. You rarely get both simultaneously.
Right.
But if we systematically break down the profitability metrics in this Q1 report, that growth at all costs concern just completely dissolves.
Okay, lay it on me.
So in Q1 2026, Palantir posted $871 million in GAAP net income.
Let's pause there for a quick translation because, GAAP versus adjusted metrics can be a bit of a maze.
Oh, absolutely.
GAAP is the strict, generally accepted accounting principles. It includes everything, even non-cash expenses.
That is crucial context because tech companies often try to distract investors from their GAAP numbers.
Right, because those numbers include massive stock-based compensation for their employees, which obviously eats into profits.
Exactly. So Palantir's strict GAAP net income was $871 million, which represents a 53% margin.
That's already huge.
It is. But if you look at their adjusted income from operations, which strips out that stock-based compensation and other one-time expenses to show you the pure cash-generating power of their core business, it hit $984 million.
Wow.
Yeah, that is an adjusted operating margin of 60%. They are retaining a staggering percentage of every dollar that comes in the door.
A 60% operating margin while growing the top line at 85%. I mean, that seems mathematically impossible for a company moving this fast.
It really does.
It requires a level of compounding efficiency that brings us to the rule of 40, right? Which is the classic benchmark used by institutional investors to evaluate the health of software companies.
Yeah, the rule of 40 is a pretty simple equation designed to check if a company is balancing its ambitions with its reality.
Right.
You take the company's revenue growth rate and you add its profit margin.
Okay.
The general consensus in the software industry is that if those two numbers add up to 40% or more, you have a highly attractive, sustainable business model.
So if you are growing at 20% and have a 20% margin, your score is 40. You're doing great.
Exactly.
Well, Palantir's Rule of 40 score for this quarter hit 145%.
They completely shattered the metric.
Yeah.
As Alex Karp pointed out, that is a feat matched only by a few hardware manufacturers who physically build the chips powering the AI revolution.
Right, the NVIDIAs of the world.
Exactly.
Yeah.
For a software company to hit 145% means the underlying economics of their business model are fundamentally compounding.
They don't have to spend heavily on marketing or sales to acquire the next dollar of revenue. The product is basically selling itself at a premium.
Yeah, but to hit a 145% rule of 40, you can't just sell to your existing customer base. Scaling that fast requires tapping into entirely new markets.
Which brings up a great point, because historically, Palantir was viewed almost exclusively as the CIA's software company.
Right. They were the Q branch of the tech world living in the shadows.
Exactly. And you cannot achieve 104% growth in the U.S. just by upselling a handful of three-letter government agencies.
No, you can't. And the financials reveal exactly how they solved that market size problem.
Let's hear it.
We are seeing a massive shifting balance between their two primary growth engines, the government sector and the commercial sector.
Oh, okay.
For a long time, analysts believed Palantir was inherently limited by its defense focus. But the Q1 2026 numbers show a totally different reality. The overall revenue mix is now 53% government and 47% commercial.
Wow, they're almost perfectly balanced.
Yeah. Both sides of the house are accelerating, but at very different speeds. Their U.S. government revenue grew a very healthy 84% year over year, hitting $687 million.
So defense spending is certainly not slowing down.
Not at all. However, the U.S. commercial revenue completely outpaced it. It grew 133% year over year to $595 million.
The commercial sector grew 133%.
Yeah.
And the forward-looking indicators buried in the report validate that trend too.
Right, the remaining deal value.
Exactly.
Yeah.
U.S. commercial remaining deal value, which, just to clarify, is the total value of contracts they've signed but haven't recognized as revenue yet, is up 112% to nearly $4.9 billion.
And their total customer count jumped from 769 to 1,007 in just a single year.
That is wild. That means everyday commercial enterprises are suddenly buying what is essentially defense-grade software.
Well, the commercial sector is finally waking up to the exact same data challenges the defense sector has faced for decades.
How so?
Think about managing a global supply chain for a multinational corporation today. You have container ships, warehouses, weather patterns, labor strikes, fluctuating currency rates, and, thousands of suppliers spread across dozens of countries.
Right. It's pure chaos because a warehouse manager in Berlin doesn't use the same software system as the shipping fleet in the Pacific.
Exactly. The data is entirely siloed.
The left hand has absolutely no idea what the right hand is doing.
Yeah, and from a data architecture perspective, managing that fragmented global logistics network is remarkably similar to running a military defense operation.
Oh, interesting.
You have disparate systems that refuse to talk to each other, and you need to make critical, real-time decisions in an environment where conditions are constantly changing.
So commercial enterprises realized that the software architecture required to track, say, armored vehicles on a chaotic battlefield is incredibly effective at tracking semiconductor inventory moving across the Pacific Ocean. But if these everyday commercial enterprises are suddenly shifting to Palantir to solve their data silos, what exactly is the product they're logging into every day?
Well, it's not just one thing.
Right, because looking at the 10Q, Palantir doesn't just sell one single app, they have an entire product ecosystem. And I think we need to translate how these pieces actually work together.
Yeah, instead of looking at their products as a list, it really helps to look at them as an operational pipeline.
Okay, walk me through it.
It starts with a company's fragmented data. To fix that, Palantir deploys Foundry.
Foundry, okay.
Right. Foundry is their foundational data operations platform for commercial industries. It acts as the great integrator.
So it pulls in all those siloed spreadsheets, legacy databases, and live sensor, feeds into one central operating system.
Exactly. It creates a single source of truth for the entire corporation.
And meanwhile, on the government side, they use Gotham to do essentially the same thing for defense and intelligence agencies.
Right. Yeah, Gotham is their legacy platform for identifying patterns hidden deep within complex classified datasets.
Okay, so you have the data integrated into Foundry or Gotham. Then what?
Well, once you have all that data integrated, you need a way to interact with it intelligently. And this is where AIP, the artificial intelligence platform, enters the picture.
Right, AP.
Launched in 2023, AIP allows users to securely connect third-party large language models, the kind of generative AI models we hear about every day, with their newly integrated proprietary data.
And tying the data in Foundry to the AI models in AIP is this concept Palantir constantly talks about in their filings.
Ah, yes, the ontology.
Yes, the ontology. I have to be honest, whenever I hear the word ontology, I think of a college philosophy class discussing the nature of being and existence.
Yeah, it's a heavy word.
Right. I do not think of enterprise software.
Yeah.
So, in plain English, why is this ontology the secret ingredient making companies run to Palantir for AI?
Because the ontology solves the most dangerous problem in enterprise AI today. Right now, a lot of companies are taking a standard generative AI model and just blindly throwing it at their messy corporate databases.
Oh, yeah, that sounds like a recipe for disaster.
It is. That results in hallucinations where the AI invents facts, or worse, massive security breaches, where an AI model accidentally reveals confidential HR data to a junior analyst.
Yikes. So Palantir's ontology acts as the crucial translator and the ultimate guardrail between the AI and the business reality.
Exactly.
But how does it actually build that guardrail?
It systematically maps the digital data to physical reality. It doesn't just see a cell in a spreadsheet that says the number 100.
Okay.
The ontology is programmed to know that 100 represents, say, physical aircraft engines sitting in a specific warehouse in Germany.
Whoa, okay.
Furthermore, it knows the business logic. It knows exactly which employees have the legal authority to authorize moving those engines, and it knows the compliance rules governing their transport.
I love this distinction. So if you ask a standard consumer AI like ChatGPT to, quote-unquote, move the engines, it might write you a really nice poem about moving engines.
Right, exactly.
But if you ask a Palantir's AIP to move the engines, the ontology checks the global supply chain, verifies your employee's security clearance, checks the compliance regulations, and then physically routes a delivery truck to the warehouse.
You nailed it. It turns specialized human expertise into shared digital infrastructure.
That's incredible.
Yeah, because the ontology understands the physical rules and the legal constraints of the company, the AI can actually make operational decisions safely. It elevates AI from being a fun novelty chatbot to an active operational engine.
And to assure that engine runs everywhere, Palantir uses their Apollo platform, right?
Yes, Apollo. That's the continuous delivery software that pushes updates and manages this entire infrastructure anywhere.
Anywhere. Like even offline.
Yeah, whether that is in a massive public cloud, a private corporate data center, or even a disconnected classified environment like a submarine that has no internet access.
Okay, but building a foundational ontology that maps an entire global corporation and then deploying it to the edge via Apollo. I mean, that sounds like an incredibly intense process.
It is a massive undertaking.
Right. You don't buy submarine-level AI infrastructure on a monthly credit card swipe. Are companies actually making long-term financial commitments to this? Or are these just temporary AI pilot programs where they kick the tires and churn out a few months later?
The deal metrics from Q1 2026 definitively prove this is not a pilot program phenomenon.
Let's hear the numbers.
In the first quarter alone, Palantir closed 206 deals worth at least $1 million.
Okay.
They closed 72 deals worth at least $5 million. And they closed 47 massive deals worth at least $10 million.
Just to anchor that to reality, there are roughly 60 business days in a standard quarter.
Right.
That means almost every other business day in Q1, Palantir was signing a contract worth over $10 million.
The scale of adoption is massive, but we also need to look at their whale metric to understand the true stickiness of the platform.
The whale metric.
Yeah, the filings show the trailing 12-month revenue for their top 20 customers.
And just for clarity for you listening, trailing 12-month means looking backward at the actual revenue generated over the last year rather than projecting future guesses. It is hard, realized cash.
Exactly. So the average trailing 12-month revenue for their top 20 customers is now $108 million.
$108 million on average.
Yes, and that average is up 55% from just $70 million a year ago.
That is astronomical.
It gets crazier. The filings reveal that a single client, identified only as customer I, represents 31% of Palantir's total accounts receivable.
Wow. A single customer making up nearly a third of accounts receivable is staggering.
Yeah.
I mean, you do not spend $108 million a year on a software subscription you can easily unplug. Once the ontology maps your business, Palantir is integrated so deeply that it essentially becomes the company's central nervous system.
Palantir is clearly playing a long, sticky game, and they are placing their own massive infrastructure bets to support this unprecedented scale.
What kind of bets?
In March 2026, the filings show Palantir amended a cloud hosting agreement, committing to spend a staggering $5.6 billion.
Wait, $5.6 billion spent just on cloud hosting.
Yes, over 10 years, extending all the way through 2036.
That is not a number you agree to unless you are absolutely certain your customers are going to consume a phenomenal amount of compute power over the next decade.
Exactly. Management isn't just optimistically predicting short-term growth to please Wall Street analysts.
Right.
By renegotiating and signing that $5.6 billion contract with a cloud provider, they are contractually locking in the underlying compute capacity required to support a decade of continuous massive AI queries.
They're putting billions of dollars of their own money behind the conviction that this commercial growth is permanent.
Yes.
But with an aggressive, decade-long outlook like that, and billions of dollars contractually committed, what could possibly derail them?
That's the big question.
Right. When you read through the risk factors and macroeconomic trends sections of the 10Q, how is Palantir navigating the global instability we are seeing right now?
Well, the 10Q is very explicit about monitoring geopolitical tensions. It specifically outlines the ongoing Russia-Ukraine war, the conflicts in Israel and the broader Middle East, and the recent strikes by the U.S. and Israel on Iran.
Okay, so they are openly acknowledging that the world is currently in a highly volatile state.
Yes, they are.
Usually, that global volatility is exactly what standard tech companies use as a shield.
Oh, absolutely.
Right. When a consumer tech or advertising company misses earnings, the first thing your CEO says on the earnings call is, well, the macroeconomic environment was challenging, global instability impacted our sales cycles.
It's the classic excuse.
But Palantir seems structurally immune to that excuse. The 10Q explicitly notes that these conflicts have had, quote-unquote, no material impact on their financials. They have no physical offices or operations in Russia or Palestinian territories.
Right.
Why does Palantir remain insulated from global chaos when the rest of the tech sector suffers?
It really comes back to the core DNA of the company and their Gotham platform. Because Palantir originated in defense and intelligence, global instability actually reinforces the fundamental need for their core products.
Oh, that makes sense.
Yeah, from a purely objective business mechanics perspective, when the geopolitical landscape becomes unpredictable and dangerous, allied governments and militaries suddenly require vastly more sophisticated data analysis, target tracking, and logistics management.
So the macroeconomic chaos that acts as a severe headwind for consumer advertising platforms, that acts as a structural tailwind for Palantir's defense procurement.
Exactly. They are uniquely positioned as a software company whose core utility becomes more valuable when the world gets messier.
And to buffer against any unforeseen global shocks, the balance sheet shows they are sitting on a massive war chest, right?
Oh, yeah. They reported $8.0 billion in cash equivalents, and short-term U.S. Treasury.
$8 billion.
Yeah, and that $8 billion cash position is not just a safety net, it's a strategic necessity.
How so?
Well, when you're bidding on decade-long defense contracts or multi-hundred-million-dollar commercial enterprise overhauls, the client needs absolute certainty that you will exist in 10 years to service the software.
Right.
A massive cash reserve proves institutional permanence.
That is fascinating. But, amidst all these billions of dollars in talk of institutional permanence, there is this fascinating, almost quirky detail buried in the related party transactions section of the 10Q.
Oh, I know exactly what you're going to bring up.
You saw it too. Palantir spent $3 million in Q1 alone for CEO Alex Karp's use of a non-commercial executive aircraft for business and personal travel.
Yep.
$3 million in a single quarter for private aviation. It's just this sudden, humanizing detail in a document filled with abstract cloud commitments and ontological architecture.
Well, it highlights the physical reality of the business, right?
Right.
The leadership is operating globally, constantly visiting these massive international defense agencies and commercial clients to close these $10 million deals. It requires a lot of movement.
That's a fair point. So synthesizing everything we've unpacked from this massive stack of filings today, what is the final takeaway for you?
The primary takeaway is that Palantir in Q1 2026 has successfully shed its restrictive legacy identity.
Okay.
It's no longer just a specialized defense tool operating in the shadows of the intelligence community. It has evolved into a highly profitable, rapidly scaling commercial AI operating system supported by an impenetrable $8 billion cash safety net.
And the commercial market, by spending hundreds of millions of dollars, has fundamentally validated their ontology technology,
Exactly.
which matters deeply for you, the listener. Whether you are analyzing the tech landscape for investments, developing business strategy for your own corporate supply chain, or just trying to understand the actual future of artificial intelligence.
Yeah, because Palantir's quarter proves that the next phase of AI isn't just about chatbots writing emails or generating images.
Right.
It is about deep structural enterprise integration. It's about AI actively running the logistics of the modern world.
We are witnessing the shift from AI as a consumer novelty to AI as critical global infrastructure,
Absolutely.
which leaves me with a final lingering thought for you to ponder long after this deep dive ends. We talked about how Palantir's ontology successfully wires together a company's data, its business logic, and its AI.
Right.
They map it so deeply that the largest companies in the world are spending over $100 million a year on it. So, if enterprise AI actually requires mapping the absolute physical and logical reality of a corporation, does enterprise AI ultimately become a winner-take-all monopoly market?
That's the billion-dollar question.
Right. Once that first software system successfully maps the entire DNA of a company and wires itself into every warehouse, every security protocol, and every shipping route, doesn't it become practically impossible to ever rip it out and replace it?